Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
That's right, everybody. That just happened yesterday. That was Jerome Powell, and he is the head of the FOMC, which is the Federal Open Market Committee. They are the group of central bankers, and they get together and decide the monetary policy of the United States of America. The Federal Reserve has two tools. They can raise rates, lower rates, increase the money supply, or decrease the money supply. So money supply and interest rates, those are their two tools that they have to work with. And there's an adage called "don't fight the Fed." And when you do, you tend to lose. Welcome back to How About That Crypto? I am your host, Bitcoin Stylist, and today we are talking about the interest rate hikes that just happened yesterday. Please like, subscribe, and follow. It helps support the channel, doesn't cost you anything, and it makes sure that more people get to hear this information. And the more people that hear the information, the more the gospel of crypto gets spread. Do not forget, this is not financial advice. You can use links below to do your own research. All right. So I just played a video of Federal Jerome Powell, the chair of the Federal Reserve, or the FOMC, and the head of the Federal Reserve, and they announced yesterday that interest rates are going up 25 basis points, or 0.25%, and this was expected, so the market responded positively. You may have noticed an uptick in the market yesterday, and that has to do with this announcement. So I'm going to share my screen, and I'm going to just dive right in, and I'm going to give you a little bit more information. Okay, so this is an article in the Wall Street Journal, and it's titled "Fed Slows Its Tightening with Quarter-Point Interest Rate Rise. Central Bank Acknowledges Reduced Inflation but Signals Plan to Increase Interest Rates Again in March." This is by Nick Timiraos, and it's on the Wall Street Journal. So I'm just going to read a couple things here. It says, Washington, the Federal Reserve nudged up short-term interest rates by a quarter percentage point and signaled it was on track to do so again at its meeting next month, while officials consider whether and when to pause increases late this spring. Officials agreed to slow rate rises to gain more time to study the effects of their moves. We're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. I think that's important to remember. Now, there's a lot of bullish sentiment in the market. I was just listening to something this morning, and they were talking, so very highly respected and popular person on YouTube and in the crypto space is a perpetual bull, it seems like. But they were making the argument that what is going to bring crypto down? Well, that's a good question. So let's kind of dig in a little bit here. Let me just scroll down. So I think it's important, like what all the bulls are saying, and this is like every single bull market thesis is based on the idea that the Fed will raise rates, stop, and then lower rates. And by lowering the rates, it is an easing of the monetary policy. It is a signal to the markets that we're in the clear, and people will go risk on and start betting again. And there's a lot of people that are risk on right now, and they're betting big that we're in a bull market. Now, if there's nothing to bring the markets down, then we could just stay where we're at now. We don't necessarily have to see new lows, right? Remember, this is not financial advice. I'm just kind of talking through everything that I'm hearing. So in order for the bull market case to hold, to stick, and this not just be some bear market rally or like a new resistance level to a bottom as a new bottom, then we're going to need to see interest rates reverse. But you can see here, Jerome Powell certainly Certainty is just not appropriate here, said Mr. Powell. I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. So, and then I want to just kind of scroll down here. And this is something from chief economist at Credit Suisse named Ray Ferris. And he said the Fed is likely to continue to signal it will hold rates at a higher level for longer than the market expects to prevent inflation from picking up again or settling at an uncomfortably high level. I think this is really, really important to pay attention to. This is a piece of the puzzle that I'm really kind of stuck on, and maybe to my detriment. Let me know if you disagree, if what I'm talking about isn't a concern. And if you don't know what I'm talking about yet, listen up. The posture could reflect officials' regret in retrospect at waiting too long to withdraw reservoirs of stimulus in the second half of 2021. So what he's making the argument here, which you probably heard if you watch Bloomberg or any of the news, they're always like, oh, the Fed screwed up, the Fed messed up because they left interest rates so low. They should have known inflation was coming and they could have acted sooner. Okay, so that keeps going on here. Mr. Ferris, the chief economist at Credit Suisse, says they have to live with the perception that they blew it, and they can't blow it on the way down. The Fed cannot be in a position where it declares victory at 3.5% inflation, only to have some random news shock in the system push headline inflation back up to 5%. Indeed, Mr. Powell suggested that he continued to see the risk of not raising rates enough and allowing inflation to reaccelerate to be more dangerous than raising rates too high and causing a recession. In the latter alternative, the Fed could react immediately by cutting rates, he said. Yeah, so okay. So translation is that there's a psychology at play here. Jerome Fowl, oh my gosh, Jerome Fowl, the foul ball dog. Okay, so Jerome Powell has a legacy. He has a reputation he wants to protect, and he's not a robot. So, like, he might make purely data-driven decisions, and that's possible, regardless of the fact that he doubts that the markets have recovered. However, his benchmark and what he wants is he wants to see inflation go down closer to the 2.2% mark, which is what he said in that video. So if that's the goal, and then just don't forget, like in the 70s, the reason why inflation lasted so long is because the Fed would ease up and on monetary policy, declaring victory that inflation is gone, and then it would pop back. And so they just kept having these like pops of inflation. And it wasn't until Volcker came in and raised the rates all the way up super high to break the inflation rate. And if we're to do that, then the year over year inflation just recently, if we're talking 5%, 6%, we're not even at 5% yet. So we still got another round to go. And that's actually something that I wanted to read here. Let's see. It says, let me just share my screen again. And I'm just going back to the same article if you're listening on podcast. Okay, so it says here, in December, most Fed officials penciled in raising the fund rates rate to range between 5 and 5.25% this year, with none projecting cuts. After the hike that they have approved Wednesday, that projection would imply additional quarter-point increases at the Fed's meeting in March and May. So really, the big question here is, are they going to drop rates after that? So they're on track. They've been doing exactly what they said they're doing. The markets don't seem to believe them, but this slowing is a big major bullish signal. So instead of raising it half a point or 0.75%, or they're raising it a quarter, so the expectation is another 2 more quarter rate hikes and then a potential pause. And of course, Jerome Powell says certainty is inappropriate, so they are going to just kind of keep their eyes on this. So I'm gonna wrap up with this, with the rest of this video, and you can check out the link below if you want to read the whole article about it. So here you go. Here's a message from the most important person in finance that you should listen to. And if you don't understand that, I did a deep dive into the Federal Reserve. What is the Federal Reserve? And I'll leave a link in the description below. Here you go.
The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. We have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done.
The job is not fully done. I definitely agree with that.
Others around the world.
Oops, sorry. Okay, so that is the news. Tell me what you think. And if you were listening this whole time, then you would probably be thinking, well, Robert, what could bring the market down? Well, like I said, this is not financial advice, but I think what could cause the market to maybe go back into risk off would be unemployment, waves of layoffs and unemployment going up and freezing of hiring, and then I think that would grip the market and kind of cause fear to come into this space, and then you could see people kind of reevaluate what's going on. So that's the biggest thing, other than a black swan event. I think we're expecting, and the Federal Reserve wants to see unemployment cool off. It's too solid, it's too tight, unemployment's too low for them, which causes pressure on wages to go up. So you can't really reduce inflation unless you reduce wages. At least that's like conventional wisdom and understanding. Now we could be in a brave new world. So we'll see. So let me know what you think. Leave a comment below. I'd love to hear from you. Have a good day and hodl on.